Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No one is paying attention. It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Typically, I'll pull up a long-term chart. Of course, when we're dealing with something like the SPY, it is very much tied to the US economy. So most of the time, moves like this don't happen unless, something, fundamental is happening in the central banking world. Okay, so interest rates, something significant, right? Otherwise, we're not going to get this kind of correction in stocks. And to be perfectly honest with you, this kind of correction normally occurs. I mean, if you do the statistics and go back, we're talking every sort of 8 to 10 years, right? On average, right? You get many sort of declines, but nothing like this. So this is one of the unique ones of our time, and that's born out of interest rate hikes, right? So any significant drop on the S&P tends to reflect that. If we go further back in time, you can see a similar occurrence here, which was obviously COVID, of course, and then we had a big correction in the S&P. Right, so let's start with the first major correction. So typically, investors spend a lot of time looking for corrections. So the first thing we always want to identify is get a weekly chart open, see where the highs and the lows are, because essentially, if a crisis or something major happens and you want to find a trade, what you're going to be looking to do is, I'm just going to illustrate here. First and foremost, you want to see where the low is, the absolute low, let's call it a support, and then we want to know where the absolute high is. So if we thought about this from December 2018, we had a nice little uptick in the S&P 500, market's doing well, and then COVID happened and we started to correct quite rapidly. So this puts most investors now to look at a couple of things, right? So the first thing they're going to do is you're going to look at the significant low points, right? That's the first thing, right? So where are the lows relative? So we got one low here, and then, so these are the most significant lows, right? Now, if we were to look at this under what's a premium, what's a discount, then we can use a simple market profile concept. So again, I've got a ton of videos on this YouTube concerning market profile, but a simple market profile concept is, imagine this is the midpoint, and then on either side we have the outliers, okay, so the extremes, and then obviously let's assume this is like the first standard deviation either side of the mean, somewhere around here, right? So anything on the low side of that, either at the extremes or on the lower half of the standard deviations, is going to be good value, right? So an easy way to do this is to use something like a Fibonacci tool, and yeah, I know some of you are going to hate this, but this just makes life easier. So this is the 50% mark. Below that is a discount, above that is a premium, right? So the discounts for me, I like anywhere from 78.6 to 88.6 are good discounts, but we're going to come to the concepts here, which are going to be very important. So premium, discount, right? So that's an easy measurement. So we can see where the mid is, the premium, and the discounts. We know we have a low here, which is kind of in the average area of price, and then we have the extremes here, and we're looking for discounts. Now, what markets tend to do is they tend to move around looking for where stop losses, stop orders are going to be clustered, right? So typically you'll hear a lot of people refer to this as liquidity areas, or areas where essentially you find a lot of liquidity. And that tends to be beneath significant lows and above significant highs, right? So we've already identified where the high is, and we've already identified where the low is, right? So say we're looking for a trade, we get COVID, and we start popping under these lows. Really what we want to see is a reaction, right? So we want to see a huge reaction accompanied by extreme float rotation. So we're going to start initially with the extreme reaction. So we come all the way crashing down, and then we have a rebound, right? So the first signal will be when we start to tail off and pop back in to this lower deviation.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?